Now, starting with the current account includes a trade. The trade has the first trade is a merchandise trade, so it's a tangible good, oil, wheat, corns, clothes, automobile, and so on. Computers, cell phone, things like that. That's the merchandise trade. You can also have services like the legal consulting, any type of services, patent, insurance, shipping, tourist. That's actually service. And there's also factor income, which is the payment and receipt of the interest, dividends, other income on the foreign investment that were previously made. So that includes the current account. Current account also includes the unilateral transfer. It's basically unrequisited payment, which includes the foreign aid, reparations, official and private grants and gifts. So unlike other account in the balance of payments, unilateral transfer have only one directional flow, because if you receive the aid, then never, aid is just aid, right? So one directional one. There's no offsetting flows, because if you get aid, you are not going to pay anything, right? Grant is same, gift is same. So if the debit exceeds the credit, so your payment is actually the receipt, then you have negative trade, right? This is trade deficit. If credit exceeds debit, so receipt exceeds the payment, then you have positive trade surplus, Exhibit 3.2 show the so-called J-curve effect. So following the currency depreciation. So usually currency depreciation lead good thing actually. So I mean, it's actually better for export. So it lead trade surplus, right? Trade surplus. But it is not always true, because in the short term, it may have trade deficit first. So see why. So, to increase the export, we need to have domestic producers, right? We need to have domestic producers. We are not sure if we already have these domestic producers right now, which means that we actually have to wait until the domestic producers start to produce. So initially, without domestic producer, right? Without domestic producer, we have to import. The problem is import price increases because our currency depreciated. So that's the time when it starts to actually have more trade deficit. And then after we start to export, it goes up. So trade surplus. This is called the J-curve effect. J-curve effect. So till domestic production begins, actually your trade deficit starts to increase. But after domestic production begins, then you have trade surplus. So that's the J-curve. Capital accounts. So capital accounts measure the difference between the U.S. sale of assets to the foreigners and U.S. purchase of the foreign assets. So it's basically about the purchase sale of the asset. There are three different types of the investment. First one is foreign direct investment, usually called the FDI. So these investments basically acquire a measure of control for the foreign business. So you basically, if you acquire like foreign company in foreign country, then that's the foreign direct investment. Portfolio investment is simply the sale and purchase of the foreign financial assets such as stock bonds, and you don't manage them, like you don't control. It's just for portfolio investment purpose. Other investment include the transaction in currency, bank deposit, trade credit, and so on. So in 2015, the United States enjoyed 188.9 billion capital account surplus, which means that US actually borrow more from foreigners, right? If you borrow more foreigners, then we have capital account surplus. And these finances what US trade deficit. So basically, they should finance the deficit using capital accounts. So sometimes some countries, many countries actually have so-called sovereign wealth fund. That's actually government-controlled investment funds. It's actually increased the role right now, especially the oil countries like Saudi Arabia, like UAE, Dubai, huge sovereign wealth funds. And Singapore also has big funds. In Asian, Middle Eastern countries, usually are responsible for recycling foreign exchange reserve of those countries sold by trade surplus and oil reserve, because they have a lot of trade surplus because of the trade and oil, and they invest to other countries, and this finances the trade deficit of other countries. Now there are two more accounts. Official reserve account is include the gold, foreign currencies, SDRs, and the reserve position in IMF. So that's called the official reserve account. And then finally, the last one is the statistical discrepancy. As you know, it's very hard to match exactly right because there are lots of transactions, right? So there are going to be some omissions, misrecording transactions. So we use the plug figures to get things to balance. So it means that the statistical discrepancy is kind of just the mathematical plug figures, that makes us match the disbalance of payments. So these summaries, like the expense 3.1, summarize the US balance of payment 2015. And as you see here, this is the balance of the current account, and the balance of current account is negative. So the United States actually usually have the trade deficit, but also has the capital account surplus. So it finances part of the trade deficit, and then there's some official reserve, and the other part probably is the statistical discrepancies, because it should match. It should match. There may be some error every year, they just match it. So there are four kinds of the accounts in balance of payments. And next videos, I will explain about the balance of payment identity.